Welcome! In this video, I will explain you what is a stock, how you can buy stocks, why companies issue stocks, how you can make money with stocks, the benefits and risks of owning stocks, and much more. Let's get into the video. What is a stock? This is Peter. Peter has worked his whole life in coffee shops, and he loves it. Serving the clients, talking and sharing ideas with some of them, seeing the smile on people's faces when he starts preparing their order. He lives a happy life, and he has a dream, one day to open his own coffee shop. After several years of saving his salary and the money he makes from tips, he has $100,000 to start his own coffee shop. He decides to proceed with that idea. After a while, he finds the perfect location for his new coffee shop, and he opens it to the public. In the first weeks, because it's a new business, he only has a few clients. As time goes by, he starts attracting more and more clients to his little coffee shop. And then he faces a new problem. His coffee shop is too small for the number of clients that he has. One day, one of his old clients from the previous coffee shop comes up to him. His name is John. And Peter talks with John about the coffee shop being too small, and he wishes he could do something about it. After hearing all of Peter's problems, John questions him. "Why don't you open a second coffee shop?" "That would be great," says Peter. But after investing in the current coffee shop, Peter only has $20,000. John says, "My dear friend Peter, look for a location for the second coffee shop and tell me the price to start the second business, and I will find a way." After a while, Peter finds a great spot for the new coffee shop. But to start, he needs $200,000, and he only has $20,000. He tells John about it. There is something you guys don't know yet, is that John is an investor in the stock market for over 15 years. He proposes to Peter to think about a second coffee shop as a company in the stock market. Peter only has $20,000 to invest, and John has another $20,000 he wants to invest in the business. So, they find 8 more investors with $20,000 each, so they can have all the money they need to invest. Peter now has all the money he needed, and each investor owns 10% of the new business. This means that the company, the second coffee shop, has 10 stocks, and each stock corresponds to 10% of the company. Any of the investors can sell their stock to another person for a higher or a cheaper price, depending on how the business is going. Each month, the company distributes the profits from the business to all their shareholders. If the coffee shop made $10,000 profit in that month, each of the investors will make $1,000. This is what is usually called dividends in the stock market. A stock is a security that represents ownership of a certain corporation. When you buy a stock in a corporation, you are buying a portion of the corporation's assets and profits. Nowadays, any person, like you and me, can invest in the largest companies in the world with a click of a button. In seconds, we can own shares of a certain company. For that, you just need to search for the best brokers in your country and open an account. Stocks are a great investment for normal people. You can invest any amount you want, and you don't have to spend time managing your money. Each company that you invest will do that for you. There are some factors that affect share prices, such as global economy, sector performance, government policies, natural disasters, and the most important one, investor sentiment. If the investors believe that the company value will increase in the future, they will start buying shares in the company, and the value of the company will automatically increase, based only in the investor's opinion. The same can happen when investors start selling shares of a company. The price will immediately drop. Why do the largest companies in the world go public and issue stocks? The largest companies in the world are all in the stock market. And why is that? Pretty much as Peter, the largest companies in the world don't have unlimited funds. and they need investors and shareholders to invest in the company so that the company can get funds to grow their business. Either that is to open a new location, like Peter's coffee shop, to launch products, like Apple, to invest in research, like Pfizer, and so on. There are two ways an investor can make money from his shares. Number 1, if the price of a stock goes up during the time they own it, and they sell it for more than they paid for it. Number 2, through dividends. Dividends are regular payments to shareholders. Not all stocks pay dividends, but those that do typically do once a year, twice a year, or quarterly. Let's go back to Peter's history. After a few years, the coffee shop is a success. All the investors are happy with the growth of the company. The company initially was evaluated at $200,000, but now, after 4 years, the coffee shop business is worth $400,000. All the investors that had invested $20,000 4 years ago in the coffee shop, now their percentage is worth $40,000. And not only that, but during those 4 years, every month the investors got paid the dividends from the coffee shop profits. In 4 years, each investor got $57,600 in dividends. That's $1,200 a month per investor. This means that in 4 years, each investor had a profit of $77,600, $20,000 from stock appreciation, and $57,600 from dividends. There are some benefits and some risks of owning shares from a certain company. When you invest in a company, you have 4 main benefits. Number 1, the economy is always growing. Historically, the economy is always growing. Some sectors grow more than others, but historically, every sector grows. The economy growth creates jobs, which creates more income, which creates more sales, and more sales means a bigger paycheck, which means more money to spend in the economy, and so on. This is a cycle. By being an investor, this growth will affect your investments in a positive way. Number 2, a great way to stay ahead of inflation. Historically, stocks have averaged an annualized return of 10%. That's better than the average annualized inflation rate, which is around 2% a year. This will help the investors outpace inflation over time. Number 3, it's easy to buy and sell. Nowadays, it's easy to buy or sell a stock in seconds. In the past, shares were represented on a piece of paper as a certificate. When a person wanted to buy shares, they needed to physically visit the office of a broker and make the transaction there, where they would receive the share certificate. However, today, all you need to do is have an account open on an online broker and submit your order to buy or sell a certain stock, and the action is completed in seconds. Number 4, it's cool. Let's be honest, it's kind of cool to tell people you own a percentage of a certain company. It's a motivation to keep investing. Although, there is one major risk of owning stocks, and I will tell you how to prevent it. The biggest risk that an investor has to consider when investing in a certain company is the probability of loss of capital. Before you invest in a single company, you should always do your own research about the company. Another way to avoid losing money in the stock market is by diversifying your investments. By this, I mean, do not invest all of your capital in one company. Try to spread it across multiple companies. That will lower the risk of you losing your money. Even if one of the companies you invest fails, it doesn't matter because you still have the other ones. And, historically, this diversification method works really well. I hope I gave you a better insight of the stock market and how it works. Thanks for watching until the end. If you like the videos, consider subscribing to the channel to see the new videos. Also, leave a like in this video. See you in the next video. Bye!